You're listening to the Rent Roll Radio Show with Sterling Chapman. Hey, Rent Roll Radio listeners, welcome back to the show. I'm your host, Sterling Chapman, and we're joined today by Steve Keighrey with Homebuyers, Louisiana. Did I get that last name right, Steve?
It's pretty close. Keighrey. It's pretty hard to pronounce. Keighrey.
Steve Keighrey. Steve, welcome to the show, and thank you so much for joining us. And first, could you explain to us why you have an Australian accent in South Louisiana?
Yeah, so I came here on a vacation 4 years ago, and I never left. So that's why I'm here. You know, we fell in love with New Orleans, just the culture, the people, and then just business-wise and like property-wise.
Sure.
I saw the opportunities in that. So we moved our whole life here, man.
Awesome. So can you take us back to kind of what you were doing before, how you got into real estate and what you're doing today, and just kind of give us the rundown.
Yeah. So like many people, really, like a big Robert Kiyosaki fan. I was lucky enough to hear him talk in 2000. So in Australia, in Sydney. So I was at college at the time, and my friend dragged me there. I wasn't into personal development. I wasn't into finance, and man, he just opened something in my head. And so I was studying marketing and economics at the time at university. I had 2 years left of my degree. So I just kept reading those 2 years, and I decided to not get a job when I graduated. Like Robert Kiyosaki says, you want to be on the B side of the quadrant, start a business. Sure. So I went all in on that. So I had the Robert Kiyosaki philosophy of build a business to buy properties. So that's really where I came from. And I'm probably less of a property person, even though I invest full time now, but I really started in the business world. I was lucky enough. We had some really good business partners. We created a pretty significant business in Australia, very similar to like Home Advisor and Angie's List in America, where you connect contractors with consumers. And we grew it. I grew that to 300 staff. We had a bunch of success, but I started buying properties. So that's when I started buying properties. I just, after many years, I got a really good income. So as well as, like having a company, I was paying myself because we had investors. So I needed to get paid. So I used that income to start purchasing rentals. I ended up acquiring like 6 single family rentals, nothing fancy, just like buying off the MLS. I did pick areas. They weren't where I lived. So I really did research the areas and growth drivers, etc. So like I did that part, but I wasn't that hands-on. But then I decided to leave the company. It just really outgrown me. I was able to sell a bunch of my shares, so I was pretty liquid. And again, Robert Kiyosaki, his book, Retire Young, Retire Rich, talks about taking a year off when he sold his first company. That's what I did. And that's what brought me to America. Like it was a year off. We love America. New Orleans, our favorite city. So we came here for 6 months. So it was a significant holiday, significant vacation. Nice. And that's really when, we wanted to come here. I started to learn about the property market. I started going to meetups. I bought a deal actually off a wholesaler to sort of set up my business over here. And I didn't know what wholesalers did. They didn't really exist in Australia. So I learned, and I went to like a course on wholesaling, and I learned it was sales and marketing. And that's what I did for our company. I was chief marketing officer. I had 90 salespeople that worked for me. So when I saw it, I'm like, dude, that's my skill set. So then I started wholesaling at first, learned the market, was, moving deals. And then once I became confident and really learned from all the buyers I spoke to, I started taking properties down myself, really using the BRRRR method. I had cash from my business. I was able to buy cash, fast close, and then refinance out those properties and build a portfolio, which is where that long-term wealth, I believe, comes from.
Awesome. No, great story for sure. So what type of houses are you buying? What does your typical deal look like?
So, I'm pretty much interested. I do the BRRRR method, right? I'm sure everyone knows, but there's capital B, capital R, capital R, capital R. I sort of go capital B, little r. So I like a little rehab. So I will buy anything where I feel I can get all my money back and cash flow. Like if it's going to meet that, that's really my criteria, but with a little rehab, and that's hard to get. Obviously I do wholesale, so I do a lot of marketing. So I'm luckily the source of the deal, and I'm able to like cherry pick, houses that don't need too much work, but are still priced right. I'm going to take that down myself if it needs a big rehab.
Where all do you wholesale? Are you just in the New Orleans area? Are you in Metairie, Baton Rouge, anything like that?
Really greater New Orleans. So I mean, mainly Orleans Parish, Jefferson Parish. So definitely Metairie. I will go into the North Shore. I go in a few rentals in St. Tammany. That's it. I don't really do much in Baton Rouge. I get a few deals there. I might joint venture them with some more local people. So I'm really mainly greater New Orleans, Jefferson, St. Tammany.
Awesome. So I'm in Baton Rouge, and I'm doing a house right now in Metairie, another one in Laplace, and I've got them all over Baton Rouge and Ascension and Baker and Zachary. I'm afraid of New Orleans. I love Metairie, by the way, but yeah. I'm afraid of New Orleans because I don't know the area well, and you never know what you're going to get from street to street, right? Like in Baton Rouge, I'm like, oh, that neighborhood? Yeah, I'll buy anything in that neighborhood. Like I can fix the inside. I don't care. But in New Orleans, you could have $1 million mansion next door to a $50,000 crack shack. And if you're not like super intimate with the geography, you could really get burned. So that's why I've avoided it. I'm sure there's tons of money to be made there. I just don't know how to do it.
You're 100% right. And you do see a lot of people that come, a lot of like virtual wholesalers from out of state, like that they're notorious to get their prices wrong because it is really hard. And I'm obviously not a local, but I immerse myself in it and I connected with a local. You're a local
at this point. I mean,
I'm local now. I had to learn the market, but
they have national wholesalers that have never been to New Orleans that are
that's true. That's true.
Sitting in Des Moines, Idaho, sending me deals.
Exactly.
I'm like, I'm an hour away, and I couldn't tell you what that house worth. There's no way from Iowa you're going to know what the house is worth.
I think the biggest mistake people make, right, because most people, and mostly work, right, you sort of go 0.05 radius to pull your comps, just throw that away in New Orleans. You really need to draw a map really tight and just do not cross any major road. So like when I comp a property, it's a really tight area. And if it crosses a road, it could be 100 feet away, but it's a whole different neighborhood. You can't use that comp. So you do need to keep it super tight. And it does mean it's harder for national people to come in. You don't get the big iBuyers. So it probably creates space for more people like me who are local and intimate and can work the market. So, I mean, I definitely like it. But yeah, and I drive into some sketchy areas sometimes. I'm riding, it can get sketchy.
Awesome. So you just started your real estate business when you got here. Is that correct? Or you said you bought a few houses off like the MLS while you were in?
Yeah. In Australia. So I started investing, it was maybe like 6 years ago, and I started buying the single families in Australia. So I bought 6 there. So what was Sydney property, Australia property sucks. Like it's super expensive. Where I'm from is very much like San Francisco, really high prices. Sure. And then the rent relative to the yield is terrible. So I convinced my wife to we were going to rent. So we've always rented. And in fact, I literally closed on my first property 6 weeks ago. I'm sitting in it now, but this is the first property that we've lived in as our forever home now. But we always rented where we lived, and I bought rentals in areas that made more sense where the yields were okay. And I looked at the growth drivers. So I did geek out on some spreadsheets. I looked at population change, median income change. I put a lot of census data to narrow down my list. I looked at infrastructure projects in the area, and I'd pick good areas. And they're all 6, all in different areas. Never, to this day, I've never seen the properties.
You've never seen a property?
Never seen those 6 in Australia. The ones in America I've never seen the properties. They've grown like crazy. The appreciation's been awesome, but I never saw them. And people think I'm crazy about that. I look, friends in real estate are like, how do you know the areas? How do you know where the cafes are? And I actually think that when you're local, it blinds you. I actually think I've seen the properties better than anyone else because I look through numbers. I look through spreadsheets. I really that's how I looked. And then I got local knowledge. I connected with property managers who look after the property, and I got them to go look at them. So I'd negotiate if the numbers looked right. I'd send my property manager there, and they would validate the rents would get. They'd validate what they thought the value was, and if they'd have trouble renting it, and they're a third party that they want a property they can rent. You know what I mean? So I trusted them, and then I got a property inspection report, obviously, and that's all I needed. I had a property inspection report. I had everything laid out. I was confident in the value. I was confident I could rent it. the deal made sense. I bought it. Property managers send me reports every 6 months. I get photos of the inside. I get a full inspection report. So like I see it, but I've never been there and touched it.
Yeah. So talk to me about cash flow. How do you calculate the cash flow on these properties? Can you walk us through some numbers? This is a conversation I ask a lot when I meet other BRRRR investors, because I BRRRR a bunch of houses.
Yeah.
And so what I do, and only time will tell how accurate this is. It's hard for me to tell because I keep spending money. But so what I'll do is I'll take a house and I'll look at what the ending debt is going to be like when I'm done with all my refinances. And I go, off the bottom, I take the principal, interest, taxes, and insurance. I estimate 2% for taxes and insurance in South Louisiana. It's about right.
Yeah.
And then off the top, I take 20%, which I give to, property management, vacancy, and repairs. And then if I can cash flow a couple $100 in between those numbers, then I'm good. What is your cash flow calculation? Because it's all spreadsheet pro formas. Unless you've had the property 10 years and you can look at real data, but I'm growing at a rate where I bought half of them last year. And there was some deferred maintenance. I don't really know how it's going to shake out.
I'm looking very much like you. I'm slightly less. I'm putting aside, I think, about 15% on maintenance and capex, but I'm also allowing 10% for property management. I do a property manager, so I allow those costs.
How much do you need to cash flow on each property after doing that?
I'll be honest with you, if I can get all my money back and I'm cash flowing $100 a month, I'm happy. I don't mind. So for me, I really get excited by watching amortization and everything. For me, I view the property as a financial instrument. The fact that I'm putting that debt on it, it's 30-year fixed. Oh my God. I don't know if Americans appreciate how good that is. It doesn't exist in any other country. So coming from Australia, there's no such thing as 30-year fixed debt. It's all adjustable. You can fix for 5 years max. So for me, the 30-year fixed debt at these rates is amazing. I really believe in.
So how are you getting your financing?
So I'm able to buy cash. So in terms of initial buying, I've used all my own money, which I do need to change. I do want to, that limits you. I'm lucky I have a decent amount of capital for my business. It listed on the Australian Stock Exchange. So I was able to take some capital from that. So that I'm able to buy cash and I don't have really a holding cost in that, but I have a commercial lender who they do 30-year fixed in my LLC. I pay a little bit more than I pay 4.75%. But I'm laughing at that 30-year fixed.
Sure.
And for me, it's just an instrument. It's just I'm making one property is not a big deal. Yeah, great. You might make $2,000 a year in profit, and that's accounting for all the expenses. That isn't that exciting by itself, but I've got zero money in it. So my cash on cash return is infinite. I've got no money in it and I can just repeat that process and stack them up. And then I really get excited, watching the amortization every month. I'm only getting that $2,000 a year, but also the principal is being reduced. That's equity I'm getting. I do believe that inflation, I've been saying this for a long time and now everyone's saying it, but I've been saying for a long time, inflation's coming, put in this debt. And, now people see it. So for me, it's just that instrument.
Some people are still in denial.
Really? I thought we finally got there, but, and again, being I'm very shaped by Keighrey, and Keighrey's always said savers are losers. He's always seen that. He's always talked about the dollar coming off the gold standard. It's fake. It's fiat currency. So I've always ascribe to that and you really in reality seeing that play out right now, and I position myself to take advantage.
So what is your average deal look like? What cost range, what price range, what rent range are you buying houses in?
Yeah, so it definitely varies, but I do seem to like the slightly less valuable properties. flipper, you want those beautiful areas, and that makes sense for a flipper. I tend to find I like areas on the fringe a little bit. Like I own a bunch of properties in Marrero on the west bank of Jefferson Parish here. I own a bunch in New Orleans East, which a lot of people are scared of New Orleans East. And, there are some scary areas, but when you buy I buy single families there in nice areas, Slidell, etc. So I tend to like where the ARV's about 170, maybe 150 to 200. Like I find that those tend to cash flow when you start getting the more expensive properties. Like I have one I've got in mid-city here in New Orleans. It's a double. It's probably the most equity I've got. Like I got a good deal and the equity is strong in there, but the rents relative to that, it's actually slightly negative cash flow. I still bought it because in my portfolio, it averages out and there was equity in this good property, but it's not, I'm more excited by just stacking up those ones where they're cash flow positive. And I also feel that when you're in that price range, like when you're a bit lower, you're more safe against shocks. The top of the market, when things go down, and that'll happen, that's really where you hurt. But if you're at or a little bit below the median house price, like you're generally safe because people come down. There's always renters, there's demand. So that's sort of my sweet spot. But I will buy anywhere that I can get my money back. And you ask me rents, the rents are normally, 1,200, 1,400, something around there.
Cool. So what's next for you in your business?
Great question. More of the same for now. I'm just trying to stack the properties. My goal is to have 100 cash flowing properties. I'm at like 25 now. So I want to get to 100 there. I do need to grow my business. So I'm here on what they call a business investment visa. So I need to have a business and employ people. So, I need to have 5 employees and so I need to maintain a business like that. So my goal is to have the business running, build the properties, but I'm not so aggressive these days. I've taken a lot of risks. I had the big company and, that's really risky and there's a lot of reward, and I'm lucky I was able to cash out some reward. So I'm sort of I'm not as aggressive as I once was. And I'm pretty happy to see that 5 staff, just stack some properties, really balance, just get the cash flow and balance, work versus enjoying life.
Awesome. So how many properties would you say you wholesale versus keep?
It really depends. It depends on the season, right? So I
can't buy them all the time.
when I first started, I wholesaled all of them for a while, and then I learned the market. Then for a while I kept the majority of them. Now I just bought this. I told you I bought my forever home. It's a pretty substantial house. I put a lot of cash into it, so I'm actually sending out more deals right now because I'm just a little bit
building it back up. Yeah,
I'm a little bit less aggressive, and I am trying to build some contingencies. I think the risks in the market are definitely higher than they've been previously. So I'm still buying, but I'm just trying to have more reserves and just be a little bit safer. So at the moment, I'm wholesaling more.
No, I'm with you. I'm selling those houses, and people are like, "Why are you selling houses?" I was like, "Because I need money." Yeah, everybody assumes that because I buy all these houses that I got a lot of money, and I'm like, it's the opposite. I don't have any money. I spend it all on houses.
Exactly. And I think you need to appreciate there's it's a roller coaster. And you need to balance things out, right? You need to go aggressive in acquiring assets, right? But then, and you got a bunch of assets. And I've followed you. I see you getting lots of assets, right? There comes a time to just balance it and get some cash, fix the balance sheet, de-risk it a little bit, and then you feel comfortable and you go again. I think that's prudent.
Yeah, no, for sure. And I mean, another thing to your point of where the properties are going to cash flow the best. I like those 150 to 200 properties. I've got a couple of 225, 250 ones I'm holding, but I'm definitely selling anything over 250.
Yeah.
And because it's just hard to cash flow, and I don't want all that equity trapped out there, not maximizing it. I bought a few houses that I anticipated being worth 250, and turns out they're worth 350. So it's do I leave that, do I leave all that equity in there, or do I cash out, refinance, and cash flow negative? No, I'll just capture that equity and redeploy it somewhere else where it can maximize its ROI.
For sure. And I think the answer to the question too depends on the portfolio, right? You need to, there's there's no hard and fast answer to should I sell? Should I do a cash out? You need to look at your portfolio and just do what feels right.
I'll say this. I go into these properties with a low cost basis and I could hold them. You know what I mean? That was always my deal. Cause for the first few years I never sold anything. And I was always like very anti-flipping because I'm like, yeah, you can make a lot of money doing it, but you can also get in trouble doing it because, you're buying a $400,000 house that you want to sell for $7 million. Well, I mean, that'd be great. But if the market tanks, you could end up with a house that you owe a bunch of money on that can't cash flow because it rents for $2,000 a month. And so where I've gotten to where I'm more willing to flip houses now than I was earlier in my investing career, I still have that safety net. Like I still go into it with decent debt and I still have like a total all in of like under 200, you know what I mean? So like I could still cash flow or at bare minimum break even if I had to hurl, if we had some like apocalyptic market tank tomorrow that lasted 3 years, I could survive it and hold everything I have. And I want to stay true to my kind of criteria to where I'm not ever getting out of my lane with those higher end flips. So I'll sell houses, but I'm gonna keep my cost base low. And if I need to hold them, it won't be an issue.
Exactly. And again, it's your portfolio. You got the portfolio to back it up. So that makes sense. You'd flip in. I just think you need to recognize the difference between long-term wealth and making cash, right? So flipping and wholesaling for me is the same thing. Like it's the same sort of income. When I wholesale a property, I make some money up front. That's great. When you flip a property, it's obviously you're going to make a bit more money, but you're going to put more effort and risk into it. Like that's great. You get a flux of cash, but you need to keep doing that to keep that cash coming in, so there's nothing wrong with that. And you probably need to do a bit of that, but you also need that long-term wealth. And that's where those, $2,000 a month on that BRRRR deal that you got no money in, it's like, that's not going to make you rich that year. But over time, you keep doing that. That's where the wealth comes in, So, I think there's a balance between doing both. And that's sort of what I try to do. And, I'll wholesale some, I'll keep some. And just depending where I'm at, I might keep them all, or I might be wholesaling them all for a period of time and just keeping that balance happening.
Awesome. So I want to hop over to our radio round real quick to help our listeners get to know you a little bit better. So it's just 3 quick questions. The first one is, what's your favorite book?
Yeah, I'm going to say Retire Young, Retire Rich by Robert Kiyosaki. I know everyone says it's Robert Kiyosaki.
Everybody says Rich Dad, Poor Dad. So I'll take a different Kiyosaki book.
Because I would like to belabor that point though, right? Because I think Robert Kiyosaki's influenced everyone. I met him here in New Orleans actually. And after I saw him in 2000, I saw him again and I'm like, I wanted to go speak to him and tell him the impact he had on my life, how I'd never had a job. And I did. But there was a massive line and I realized, I thought I had this cool story and I realized everyone had the same story. And I'm like, that's amazing. Like what an amazing guy he is. But there's a lot more to it than Rich Dad Poor Dad. Like I've read every book. I've literally read he's done a lot of books. I've read every single book. I listened to his radio. Like it goes a lot further than just Rich Dad Poor Dad. Like I bet everyone's read it. I bet everyone loves it. They've probably read Cash Flow Quadrant. My thing is keep going, read them all, listen to the podcasts. There's just so much value there.
Awesome. No, definitely. And if you run into him again, tell him that I'm trying to get him on the Rent Roll Radio show.
Deal.
The next question is, what's your favorite quote?
I love Robert Kiyosaki's quote, which is, to be successful, you need to be incompetent and lazy.
Nice.
and to let that land a little bit, it's obviously very grating and that doesn't seem to make sense because that isn't that the opposite. And just to explain that quote, because I like the quote because you need to think about it to actually understand what he's saying, right? And really his point was, you don't want to be the smartest person. If you're the person that's the smartest, you have to do everything. You can't grow. As a business person, you have the smart people around you. You direct, listen, hear, and that's actually how you do a lot more. And being lazy is that same thing of outsourcing, replacing yourself. You want to hire people. So that's my favorite quote because it's just so jarring and so powerful. It's the opposite of everyone thinks.
Awesome. And what's your favorite thing to do outside of work?
obviously spent time with my family, my wife and kids, and the Saints, man. I'm a big Saints fan. Half the reason I moved here.
Well, cool. How can our listeners get in touch with you, find out more about you, connect with you?
Probably best to maybe through LinkedIn. Hit me up through LinkedIn, Stephen Keighrey. You can hit me up on Facebook. If you're in New Orleans, we run a meetup here actually on the West Bank the second Thursday of every month. The West Bank Real Estate Investors, look that up on Facebook. We go there and we catch up and we drink and network as well as having speakers.
Awesome. Well, thank you so much for joining us today. I really appreciated a chance to get to know you. I'll definitely come check out your meetup if I can make it out to the West Bank. And if you're ever in the Baton Rouge area, feel free to come by the Red Stick RIA. That's
on my agenda. I'm definitely going to come down. I've definitely been watching you guys, so I'm definitely going to come down. And I'm really glad to meet you. I've followed you on Facebook, so I wanted to connect with you as well as your listeners. But great to chat more.
Awesome. Thanks. Looking forward to keeping up with you on your journey.
Awesome. Cheers.
Thanks for tuning in to the Rent Roll Radio Show, brought to you by Crestworth Capital. We hope you enjoyed the show, and if you did, please hit the subscribe button and leave us a rating and review. You can also visit us at crestworthcapital.com or rentrollradio.com, or follow us on Facebook at Rent Roll Radio or at Crestworth Capital. If you would like to reach us, feel free to shoot us an email at info@rentrollradio.com or sterling@crestworthcapital.com. We hope you come back next week to join us on some more of our journey. Until then, happy investing.